Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management. Practical question 2. Following information is available in respect of expected dividend, market price and market condition after 1 year. The market condition along with probabilities are given for the share. So market price and then dividend per share also. Now the existing market price of equity share is 106, face value being rupee 1, which is irrelevant here, and which is come 10% bonus debenture of 6 rupees each per share. So this share is having a bonus debenture issued which is costing rupees 6. So the actual cost of the share will be 106 minus that 6 rupees debenture, which will be just 100 rupees. Messrs X Finance Company Limited had offered the buyback of debentures at face value. Now they are trying to buy back the debentures, which is 6 rupees. Find out the expected return and variability of returns of the equity shares, which is nothing but standard deviation of returns, if buyback offer is accepted by the investor. So expected return can be found out using the details on the information given for the shares. So wherein we will be taking the cost is 100 as previously told, which is nothing but 106 minus the debenture bonus debenture 6 rupees will give us the net cost of the equity share, which is 100. Then the return we are getting from the share in case of this market conditions. So 115 plus 9 will be 124 and minus 100 will give us 24. In case of normal return, 107 plus 5 112 minus 100 will give us 12. In case of bad, 97 plus 300 minus 100 will give us nothing. So the expected return will be nothing but the net return multiplied by the probability divided by the cost, which is 100, will give us the expected return. Ideally we should get this return by considering the percentage. Here since the cost is 100, the percentage also will be same. Otherwise we should find out like this: 24 divided by 100 into 100. Here it is 24% and 12% and 0%. Then this returns has to be multiplied with the probabilities to get the expected return. Why? Because if in case the cost was 105, then the return will obviously change. 24 divided by 105 into 100, which will give us a different return. That return has to be multiplied with the probability. So we have to be careful in the case. Since the cost is 100, they have directly multiplied with the probability to get the expected return. Now the next requirement is variability of returns, which is nothing but the standard deviation. So the same, whatever return percentage minus the expected return percentage, the difference squared multiplied with the probability will give us the variance. So the total variance is 72 and root of the variance will give us the standard deviation, which is the variability of returns. In our case it is 8.49%. Now the third requirement is whether the company should accept whether to accept the buyback offer or not. So we need to know why the company might be going for this buyback. The possible signals of this buyback are, it might be the company having a surplus liquidity, or it is trying to reduce the ongoing interest cost which is paying on the debentures, or it is trying to improve some leverage ratios and try to clean up the balance sheet, like by reducing the debt and increasing the equity. This might be the possibility. Now, the decision regarding buyback should be taken based on the maturity period of the debentures. Why? Because if the debentures is expiring or going to get redeemed in the near future, like in 3 months or within a year, then it would not be beneficial for the company, as it will get redeemed automatically within a year, and the company will not be spending much interest and will not be spending much cost on this debt bearing debentures, debt instruments. If it is in a long term, then the company can go ahead and accept the buyback, as the company is already giving a good return, and if the company has surplus funds, then they can redeem the debentures and invest in a better opportunities. So we have to decide the buyback based on the maturity period, but in the question they have not given further information regarding when the debenture is going to get redeemed or not. So the same answer they have given. Mrs. X Finance Limited has offered the buyback of debentures at face value. There is a reasonable 10% rate of interest compared to expected return 12% from the market. Considering the dividend rate and market price, the credit worthiness of the company seems to be very good. The decision regarding buyback should be taken considering the maturity period and opportunity in the market. Normally, if the period is low, say up to 1 year, it is better to wait, otherwise to opt buyback. So that is same as what we have discussed. Thank you.